Hey everyone, and thanks for jumping back into the Equityverse. Today, we're going to talk about the S&P 500 seasonal correction that we previously talked about. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com, where you can, of course, get access to the chart like the one we will go through in this video. Now, we've previously talked about how the S&P 500 tends to get a correction in August or September of the pre-election year. And if you take a look here at 2023, you can see that that correction has in fact materialized, and it very well might not yet be over. If you look at it within the context of what occurred in 2019, you can see that it occurred basically at the exact same time. If it continues to emulate that, it could still stay risk off, for actually several more days potentially before finding any type of renewed strength, maybe even another week or two. However, if you look at 2015, you'll find that that risk-off environment actually persisted for a lot longer, right? You can see it started to sell off here, but then the big sell-off didn't actually occur until day 231 or 232 or so, and we're currently on day 221, which means it could still, in fact, be another week or two away if it were to emulate 2015. Now, in 2015, we know there was actually a lot of recession scare at the time, which I mean, that's not to say there's not a recession scare now. I mean, I think there is with an inverted yield curve. But we still do have relatively good numbers in the jobs market. The unemployment rate, initial claims, continued claims are still relatively low. And until that stuff goes up in a material way, then that recession risk, I don't think, will be priced in. Now, once you start to see the labor market move, then the recession risk can get priced in quite quickly. But until it actually happens, it's hard to say that it's priced in. So you can see some examples, of course, like 2019, where the S&P continued to rally in Q4 after getting that seasonal correction. But you can also find other examples like in 2015 where it did not take out the prior highs. And that was more so associated with a recession scare more than anything else. And you can look at 2011 and find something very similar in terms of a risk-off move that occurred around this time frame. And what I'd like to do is what we sort of did in the prior video, where we talked about before we had this correction in the S&P 500, to take that average of several of the last pre-election years, 2019, 2015, 2011, 2007, 2003, 1999, the list goes on and on. But just to average out the last 6 of the pre-election years, this is what the S&P looks like. And so you can see that it's actually getting a very seasonal correction as it normally gets. And on average, once it hits the lows, on average, it can hang around those lows for, potentially another month or two. So that is just something we talked about previously about how the S&P 500 tends to get a seasonal correction in August or September of the pre-election year. Whether it pushes higher in Q4 will likely be up to whether a recession risk materializes between now and then, which we'll try to talk about. That's what we talk about, the macro stuff. We look at jobs reports, we look at initial claims, continued claims, job openings and stuff. That's what we talk about the macroverse. And of course, up until this point, the labor market has remained relatively resilient. And we would need to see initial claims printing probably well into the 300,000s on a continual basis before it's going to have any material impact on the unemployment rate. But at this time, it does appear that that seasonal correction in the S&P has in fact materialized. And the question is if it hangs around these lows or presses lower, like it typically does in the pre-election year, then that could cause other risk assets like Bitcoin and the altcoin market to get hit a lot harder. In 2019, remember, the S&P rallied into the end of the year while Bitcoin and the altcoin market fell back down. Okay, and again, the divergence was in August or September or so when Bitcoin got weekly closes below the 20-week SMA. All Bitcoin pairs sold off and most of them capitulated, and then kept going lower on their USD pairs, the altcoins, while the S&P continued to climb the wall of worry until the labor market finally started to make that move. So we could see a repeat of that, right? We could see a repeat of where we see the S&P, we have the seasonal correction. If it persists long enough, it could cause cryptocurrencies to get those bearish weekly closes, send them into a downtrend for the rest of the year, while the S&P could climb the wall of worry until the recession risk materializes, which I do think will happen at the end of this business cycle. But for all we know, it might not be until Q1 of 2024. We had a recession in Q1 of 2020, we had a recession scare, I believe, in Q1 of 2016. Perhaps we'll see another one in Q1 of 2024. Anyways, we'll wrap it up there. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up. And again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Bye.